Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall Series. I'm Eric Auskerson, one of your hosts for today, and we've got an action-packed hour in store for you. So we're going to be kicking things off with an economic forecast with Steve Liesman. And then Barry Melanson is going to be talking about what's going on in D.C. We've got a BOI, beneficial owner information update from FinCEN, which Lisa Simpson will be moderating. And then we're going to get into some cybersecurity items with Randy Johnson and Chris Comer. So right now, I'd like to bring up Steve Liesman. It's been a very, very busy week for Steve. He was in Washington, D.C. for the recent announcement from the Fed chairman. We've got a number of slides that we're going to be reviewing with him. So welcome, Steve. And just to kick things off, your forecast, look at this, 100% said the rates would be unchanged. So I guess 100% got that answer right. How do you?
Yeah, I wish they could get the rest of it all right. But yeah, what I'm going to share with you is our CNBC Fed survey. And I've been doing this for a very long time, maybe 15 years now. I know this because, well, anyway, we just go back and reviewing some of the old stuff. But yeah, the accuracy comes and goes. But this, we put this out on the Tuesday of every Fed meeting. And, you know, obviously you can tune in and read it. We have it on CNBC.com if you want to read it there. But I think I'll just share with you some of the basic parts of the outlook here. And this is what we call our Fed expectations chart. Don't get too hung up on the numbers when it comes to the rates. 5.29, it's 5.38 now. It gets a little bit lower because of different forecasts in there. But basically, the feeling of the group, 31 economists chime in on this, is that we're at the peak rate right now. The important number there is that 10.4 months. This is the higher for longer seeping into the psyche of the market, the idea that the Fed is on hold until September. And that's when you get this 57% majority say, well, that's when the Fed's going to start to cut. So it's a long way off. They're going to be above 5% according to this forecast right now. And I'll be able to explain to you why when we go through the slides here. I'll try to burn through these pretty quickly and leave time for questions and stuff like that. We'll go to the next slide now. Okay, so what's ahead for the economy? We've been asking the recession question for a long time. A couple months ago, it crept below 50%. The data kept coming in stronger. And I have a nice graphic I'll show you on that in just a little bit. And then we also started asking more recently about what's the probability of things coming out okay? We never asked that question. So there's a 42% probability of a soft landing. These are not either or questions. We ask these questions separately. So you can see how something's, well, there's a 49% chance of that and a 42% probability of that. Let's go on to the next slide. I'll show you some of the numbers that they're digging in on. There's the outlook for the Fed funds rate. Again, don't get too hung up on the exact numbers. Look at the 538. That's where we are right now. Same number for the end of the year for all intents and purposes. And then look at the expectation for next year, about 75 basis points of cuts built in, and then another, call it 75, call it 80 for December 2025. We're going down, but we're going down slowly. And I think the next chart will explain why that is. And that's because,
well, Steve, we got some questions coming in here. Where do you see this? So this is, I mean, based on what's happened. How do you, I mean, this is your forecast data, but how do you personally kind of look at this?
You know, this feels about right. I have a kind of sense that maybe they can begin cutting earlier than September. The market is priced for June. The way to bet against this forecast is to have a different inflation forecast. If you think inflation can come down faster and sort of stay down on a consistent basis, the Fed will feel more comfortable cutting interest rates faster. I think we've had a bit of a bumpy road. We had a couple months of, if you go even back to the beginning of this year, we started off really optimistic, and then that progress was actually revised away a bit. Then we had a couple lousy months. Then we've had a couple good months. We brought inflation down a lot. We have a ways to go. The Fed is not going to come off of its 2% target rate on inflation until they hit it. Then they might actually come off of it after that, but they won't come off of it until they hit it because there's a major credibility issue in here. I have a sense and a hope that inflation is going to come down more quickly than they suspect. So they might be able to get to cutting by the summer. Late spring would be a really optimistic point of view. That would be my forecast.
There's a chance that they're done.
I think they're done. Yeah. And then, so here's the reason why they're going to be at a higher rate for longer. And if you notice that last screen was 374 in 2025. The importance of that is that that's above sort of the long run rate, which should be more 2.5. They may settle at a higher rate for longer if indeed what we call the neutral rate is higher. But this is the proximate cause here, the more near term, less structural reason why they're going to remain higher. And that's because inflation, at least in the view of the forecast. And what I like about this forecast, by the way, is it's an average of forecasts and models on the street rather than a single forecast. Nobody has the exact right model, but I think we get better results by averaging some of the forecasts out there. You see what happens. It comes down slowly, and they're still above their target by 2025, though they are nearing it. And then real quickly on GDP, we'll go through that. And what's interesting about this next one here, okay, so if you look at the bar in the middle, the 0.73, that was kind of the forecast for this year. That didn't happen. So what has happened is the forecasters have pushed ahead into next year the slowdown they thought was going to happen this year, and then back to trend growth or potential growth by 2025. Now, the next slide should completely undermine confidence in everything I've told you.
Well, Steve, just before we move to the next slide,
go ahead.
They've been, comments coming in. We've been predicting this recession now for 2+ years. It never comes. Is this so? Here we got 0.73%. This goes back to an earlier slide. Where are you on?
Well, that's
everyone feels like a soft landing is happening. I guess this is the GDP outlook predicting that soft landing.
I want to make the questioner's point in the next slide, which is really great that he asked that question. So, all right, what you're looking at here is the forecast in each one of our surveys. And just making the point of the questioner there, who's very smart and has followed this thing perfectly. The green line there is the forecast for this year. So let me translate this complicated chart. If you look on the left side, in December 2021, we thought it was going to be a 2.8% year in 2023. Go ahead to the middle there. Look at that 0.18. November 2022, the green line, the point there, we thought it was going to be a year of just 0.18% GDP. And then it gradually crept up. So you're absolutely right. They kept forecasting this thing. It kept not happening. I'm very happy to have been early and on board with this idea of questioning the inevitability and the consensus on the recession. I think that's been the right call. I do think things slow down from here now because of the fact that interest rates, higher rates, have really started to creep into the economy. The idea that the Treasury rates are higher, we went for a while there with the 10-year not really fully reacting to what the Federal Reserve was doing. I think it's reacting now, and I think now we'll probably have something of a slowdown. I think the mistake a lot of economists have made is they've relied too much on the pandemic savings and stimulus being behind the consumer spending, which is held up. If you look at this green chart, the reason why that you have that huge upslope on the right in those big chunks is because consumer spending kept coming in stronger than people expected. And that's what caused the whole rethink of this year. And I think with the job gains that we've had, the payroll gains and the wage gains, I think that's what's powered the economy so far. And I pretty much expect that to continue.
Well, we can take the slides now. We got some more really good questions coming in.
Sure.
This is something that you and I talked about before we started today. And this is regarding the debt. Given our levels of debt, is the Fed really able to control rates? So why don't you talk a little bit about the debt, talk about, that impact on the rates and on the economy?
I think the debt is something that's going to have to be addressed at the congressional and executive level now. What happened this year, I was just trying to go through the numbers this morning. I was trying to figure out where the surprises came from. A big surprise was capital gain taxes were $500 billion less, or personal income taxes were $500 billion less than had been expected, $450 billion in fiscal 23. And a big part of that was capital gains taxes. Corporate income taxes also have also been not hit the mark. And then, of course, you have an acceleration in interest expense. That was not a problem in 2023. It will be increasingly in 2024 unless they get something of a handle on this. And I don't know if that means we did ask a question on this in the survey. 42% want to just raise taxes. Sorry, want to just cut spending. 45% want to cut spending and raise taxes. I have always tended to think that the real or the right answer to this question is both on the revenue and on the spending side. We don't. There was not a huge increase in defense spending, despite all the publicity that the aid for Ukraine and Israel gets. There was not a big jump there, not above what was planned. The spending side actually was fairly well controlled this year, 23, relative to budget. Now, the budget had it going up, but that was not where the surprise came from. The surprise came on the revenue side, and maybe we'll get a little bit of relief there, but we're going to have to figure it out once. If these rates stay high the way they're expected to be, we're going to have to address it, and it is a risk to the market. It's a risk to the economy.
Well, Steve, those are great insights, and we've got Barry Melanson, the CEO of the AICPA, joining us now, Barry. So the tax revenues have been up for quite a while, but that people aren't selling as much in 2023. There's not as much capital gains. But maybe you've got a question for Steve or some comments on what we've discussed.
Well, Steve, I appreciate all the information, and I always thank you for being with us. The debt question is a perplexing one, I think, for our membership. If you think about CPAs and people who are trusted advisors, which our members really are, and just to level set that, every small and medium-sized enterprise has got a CPA relationship. And I think the debt issues really concern a lot of people, particularly because, as you know, we only measure debt on a cash basis. But, every other business in the world is looking at debt and future obligations on an accrual basis. And our accrual basis debt as a country is way, like $100 million greater, because $100 trillion greater because of healthcare and Social Security and all of those types of things. And, I think there's a lot of people that are concerned about that. Economists don't seem to get as concerned about it. I mean, you just expressed some concern, but any kind of take from that standpoint? Because, there's a big difference between this cash basis and the actual debt or obligations of our country.
Right. Well, I mean, I've covered this for a while, and the old saw about America, which is that we kind of exhaust all of our possibilities before ending up doing the right thing. We're not going to get around to solving the problem until it's in our faces. Just to be clear, Barry, what I was distinguishing from right there in what I was talking about before was the difference between the known horrors of the budget and the unknown horrors, right? The entitlement question is one that's been there, and it exists as a known fact for a while. I remember years ago, Greenspan, speaking in Jackson Hole, said, "We don't know much that's 100% true about economics. We have no definite variables or factors that we can use, but we do know one thing: the vast number of people that are 35 right now, in 30 years, will be 65." And the idea that people would age, that we were going to have these issues, those are always out there. The thing that interested me is why all of a sudden did I seem to go to bed and it was a $1.5 trillion deficit, and now it's a $2 trillion deficit? And why is it $2 trillion and maybe going up higher than that? And that's because of interest expense. So those are the new elements right there. We're going to have to address entitlements, and it's probably not going to happen this year. But perhaps in the first year of, I don't know, I guess whoever wins the election will be a second-term president.
That's
I
what
guess
it looks like.
in the first year of a second-term president with nothing to lose, who might want to put this on the table. But what is the word from the Dylan song, Desolation Row? They're fighting in the captain's tower. That's what's going on right now. And so this particular ship is headed for an iceberg, and the captains are not necessarily paying attention.
Yeah, that's it. You might be interested. We have a big effort to just try to get members of Congress to look at that accrual basis financial statement, not just the cash basis. And that, there's no desire to even think about it. And I think that's the first step to finding how to deal with it, is to actually look at it. Well,
there's the folks at the Center for Budget and Policy Priorities, Maya McGinnis, who's been screaming
Yep,
about this for a very long time, and they've been doing a good job at that. There's a question as to how to save. How would you save for it? How would you do it correctly? It's a fascinating question, and it's one that I'm interested in because I'm the last year of the baby boom, so I'm in trouble, I think.
Join the crowd.
So Barry and Steve, we got some questions coming in just on, some of these firms feeling the impact of these interest rates with their small business clients, the real estate market. So here you've been trying to fix inflation by raising the rates, consequences to some segments like the real estate segment. What you're thinking on that? Just what are they going to be in on those segments in for more of a hard landing than other segments?
And small business, Steve, because the interest rate increases disproportionately affects small business.
Well, I hate to be the bad guy here, but these are not unintended consequences. These are the consequences the Federal Reserve wants. I don't think it's right to say they want them to hit small business harder than others, but they do want to make it harder to borrow, harder to expand, harder to hire. They do want to create all of that friction in the economy that higher interest rates do create. They want the friction in the auto loan business, and they want the friction in the real estate and the interest rate sensitive sectors. And that's why today I'm sitting here not talking about a rate hike yesterday, because rates are indeed higher in the economy. The Fed feels like that's doing the work for them, and they still think there are lags to come. It kind of gets back to the question of, Silicon Valley Bank. Obviously, they didn't want it to fail. They didn't want it to create a banking crisis, but they did want the banks to feel the pressure of higher interest rates. And you would expect something like that to happen because of it. The banks are the conduit of monetary policy. They're the transmission mechanism. So, a lot of folks, I don't know about small business, but certainly medium sizes and bigger businesses, termed out their debt. And so there's not a big effect this year. In years subsequent to now, when those tranches become due, you'll have more and more companies affected by this. I think the greatest hope I can offer is that if that forecast I showed you of gradually declining rates becomes accurate, then next year will be a better year for refinancing and funding than this year has been. But it would be wrong for you to think we're going back to the days of free money. Get that out of your head. Money, I think, for a while is going to have a real cost here.
Okay. Well, maybe we're kind of at time right now, but with the presidential election season heating up, there'll probably be more talk about some of these pressures in some of these segments. So would that be another pressure you think to keep rates, flat or potentially going down?
I don't think so. I've done some work on this, and I'll look at it again. It's been a number of years. I guess it's probably been 4 years since I did it. But the Fed is surprisingly unaffected by the presidential election. I don't think they want to hike in October. I don't think they want to cut in October. But in terms of a presidential election year, I think the last time I did this, I found no difference in the Fed's proclivity to act in an election year, presidential year, rather than not. You remember the famous case of Bush saying that Greenspan torpedoed his election by raising rates in the middle of it. I feel pretty confident that if there's still inflation around, the Fed is going to hike rates and keep them high to vanquish inflation. I think Powell feels like he has one job right now, and that is to keep inflation lower, to bring it and make it go lower. And he's going to do that. And if that means higher rate hikes, now, if it's a toss-up, I think the election might affect them at the margin. If it's next month, maybe. But in the year itself, I don't think there's any particular predilection of the Fed to hike or not hike because it's an election year.
Well, thanks. Thanks for these insights, Steve. It's great to have you on our town hall with these 10,000 plus attendees. So look forward to having you back sometime in the new year to kind of talk about where things are headed in 24. Thank you very much.
Thanks for having me. Enjoyed being here.
Thanks, Steve.
Okay, Barry, good setup for what's going on in D.C. We were at council together a couple weeks ago. We showed the vacant chair of the Speaker of the House. Well, that's clearly been filled. It feels like he's been there for a long time already.
Yeah. Things. Well, it may be a long time in Speaker years. Let's call it that way. The sort of like a dog, dog year. Clearly, we took a big step as far as getting a speaker after many false, runs by individuals. And I guess really the real question is, what kind of impact does it have on the things that we're interested in? What kind of impact does it have on how the Congress functions? And, there's been a lot of frustration about the sort of polarization of Congress in general and the inability for it to actually do any work. And so if you think about it from a political perspective, clearly, you would think if the Republicans are interested in keeping the House, they really have to be able to make this work at some point. And otherwise, the American public will probably penalize them for it. So really, if we think about it in the context of our issues, I think, and Steve sort of related to it in the issue of, the government and the budget, it really comes down to the funding issue. And maybe some of our participants here might be saying, well, why are we worried about, whether the government shuts down or not? And really, the real substantive point here is when Speaker Johnson came in, he laid out sort of a plan of how he was going to function over the next few months. And, a lot of the change in the speaker revolved around how they vote on appropriations bills and things of that nature. And he has agreed to bring 12 different appropriation bills for a vote, as opposed to one massive appropriation bill that has been sort of the normal operating procedure. But lying in that sort of commitment is the funding expires in a couple of weeks in November. And they're going to have to extend the funding in some kind of way to not have the shutdown of government. And at first, he laid that out and he said, well, there's a couple different paths. We could maybe do something that extends funding to April 15th of next year. And another path was January 15th. And right now, it looks like, and this is sort of hot off the wire here in the last 24 hours, it looks like he is sort of rallying around the notion of a January 15th date. Now, that's a pretty important date to us, right? Because how that plays out from an IRS operations perspective is a pretty significant thing for the tax filing system, season. And we're all over this issue. We are making this aware in the Congress perspective. And let me just assure our members on this town hall, our tax volunteers and our tax staff, their number one issue right now, if in fact it looks like it's going to be January 15th, is to figure out what we can make happen either legislatively or through regulations from the IRS or actions by the IRS to make the tax season work. Because January 15th is probably the worst possible date as far as an effective tax season. I'm not saying April 15th would be a panacea, but actually it would be better than a January 15th. And so there's all sorts of things that's being looked at because it would be a problem. I mean, it would be a problem if the IRS is on a skeletal operation or not. We all know the service issues that we've gone through in the last several years. This is only going to exacerbate that to a much larger degree. There is some political discussion about, well, maybe we shut down part of government and not other parts of government. So we don't know for sure how this will play out, but we know for sure if it's a shutdown on January 15th, it's going to be problematic for our profession, because it's going to be problematic for the Internal Revenue Service. And then on top of that, there's another item that's it may get voted on tonight. It might get voted on in the next 24, 48 hours. And that is the issue of aid or funding into the Middle East dispute into Israel. And what has been drafted in the House is a provision for funding and the offset, sort of a dollar for dollar offset, taken out of the IRS budget. Now, there's a couple of things let's take from this point. First off, even if that passes the House, and that's not a certainty, but even if it passes the House, that is not going to get through the Senate. Majority Leader Schumer has already said that's not going to happen. So it will create noise around it, but that's not really what's going to, it's virtually no chance that that would be actually become law. But I think the second takeaway is, you know, the whole sort of change in the speakership and what is a target and what is priority. I think you can assume that part of Speaker Johnson coming in, if the IRS is targeted in this particular Israel situation, even if that doesn't become law, which it probably won't, it's going to be targeted in other places. So the IRS is going to become sort of a bullseye on this. Interestingly, the Congressional Budget Office is, forecast impacts of legislation. They've already forecasted this to have a net negative impact on the budget because, of course, the position is a reduction of funding, reduces audits, reduces tax collections to offset the actual dollar amount. Now, people will dispute that, but that's actually how the process just came in. So those are really significant issues. And one other note that I would just throw out there is the state and local tax deduction. You know, the whole speaker ultimately Johnson got all of the Republican caucus, but to get the coalition to put anyone in the speaker's chair, one of the things that is being said predominantly by the Republican delegation, the House Republican delegation from New York, is that that part of that discussion and part of that the trade-offs that were going on and sort of behind the scenes, an opportunity to look at the state and local tax deduction was agreed to. No details as to what that means. There are a lot of rumors running around, different limits, doing away, all kind of things that are out there. It doesn't even mean that it will actually happen, but there's certainly a group of Republican congressmen who believe something is going to happen related to that issue. And of course, that would have a pretty significant, it's obviously a big planning and tax result issue for a lot of people, particularly in high state tax states. The only other thing that I would say is, again, uncertain as to where that would be effective. But I think because of the sort of the revenue loss and the budgeting effect of a provision, if it were to come to be, likely to be prospective, not retroactive, as to how something might come about. So really, the big takeaway, Eric, on this is the funding. What's the ramifications to the services to the American taxpayer and the preparer community in the tax season? And rest assured that there are all sorts of things being brainstormed, and what is in the art of the doable to make it workable if it actually comes to that January 15th date.
Well, that would be very interesting development if they move something forward related to SALT in this environment of just gridlock, Barry. There's questions coming in. One is just, we haven't seen this recently, but a lot of service level questions coming in, just frustrations right now. Maybe it was something around the October 15th deadline, but just IRS service levels.
Well, the IRS is saying their service levels are better. It's interesting. I think you're right, Eric. The last, several months, and if you recall our survey, our post-tax season survey after April 15th, indicated from our members that the service levels certainly weren't back to, pre-COVID levels, but that they were better than the previous 2 years. So that's an interesting data point, and this is a prime example of the value of the town hall community, frankly, Eric. If we're hearing this in the feedback, as part of that feedback mechanism, we're going to get our team that is interacting on a multiple times a week with the IRS, see if we can sort some of that out, some of that feedback out. So thank you very much. We had not heard that feedback as much since April 15th.
Well, thanks, Barry. We've got a full show here today. We're moving on to a segment with Lisa Simpson and another very hot topic, beneficial owner information, BOI, another acronym. So thanks for being on today, and we look forward to seeing you again soon here on the Town Hall.
Thank you, Eric, and thank you for all of our participants here.
Lisa, great to see you.
Hey, Eric. Fun show. Let's dig into another fun topic.
And we're right on time.
Absolutely. I'm excited to have a representative from FinCEN, which is the Financial Crimes Enforcement Division, joining us today to answer some questions for me about beneficial ownership information. I've been talking with a lot of practitioners over the last few weeks, and I can tell you that there is some confusion and some anxiety. So I'm counting on Jonathan Dixon, who's a senior advisor with the Department of Treasury, to answer all of our questions. Right, Jonathan?
Absolutely. That's what I'm here for.
Thank you. Thanks for joining us. Really quickly, I want to remind our audience just about some of the highlights of what beneficial ownership information reporting is about. And this all came about through the Corporate Transparency Act. So you might see in communications around BOI, another acronym CTA. So CTA, Corporate Transparency Act, which was a law passed in 2021. And this all drives from global initiatives to try to crack down on money laundering. So here in the US, this is being enforced through this reporting requirement that FinCEN has released. As a reminder, existing companies will file between January 1, 2024 and January 1, 2025 with some caveats there. New entities that are subject to this reporting who are created after January 1 will have 30 days to file. And there are exemptions. We've got a link to resources that'll help you sort through some of those exemptions. One of the most important that I think a lot of us want to know about is that large or operating entities defined as more than 20 employees in the US, gross revenues of over 5 million, and a physical presence in the US are generally exempt. But if you look at that last bullet, that's what gets a lot of attention. There's some pretty stiff penalties for non-compliance. So with that, Jonathan, thank you again for joining us. I'm going to start asking questions. All right.
All right. Thank you.
So first question, a couple of days ago, the comment period ended for a proposition that was put out around extending the reporting deadline for new entities. And FinCEN has actually recommended that the 30-day window be extended to 90 days. Can you help us explain how you picked that 90 days? And do you have any thoughts on whether or not that change will happen?
I appreciate the comment, but as you noted, we just closed the comments on October 30th. So this still is an active rulemaking process. And we received about 35 comments, including one from AICPA. So we're working through those. But I think the key here is that we know this is a new requirement and that FinCEN might not be an entity that many small businesses are familiar with. So we really want to take the time to conduct this outreach, to conduct this educational campaign that we're undergoing right now, and make sure that we're putting a little bit of a friendlier face to something that, as you mentioned, has really stiff penalties attached to it. Part of that is extending this timeline for new companies, making sure that they have time to get their information together, that they can find their beneficial owners, and that they get familiar with the actual reporting requirement that we put in place.
And I appreciate that because there is a lack of awareness about these reporting requirements. So we appreciate your outreach efforts. I know you've been having webcasts and things to try to get the word out. And yes, the AICPA did submit a comment letter. I'll have our attendees check in on that in just a minute. Here's another popular question that I get. So we spent a lot of time earlier in the segment talking about a potential government shutdown. Do you feel like a potential government shutdown could in any way impact the rollout of the beneficial ownership information reporting requirements?
Sure. I mean, I don't want to guess if there's going to be a government shutdown or not, but we have set a deadline of January 1st, 2024 for this effective date. And we continue to make substantial progress towards this. And we continue to aim for that date. As you know, there's a lot of work that's going into this. We've been focusing on 5 key areas that range from putting in these rulemakings, one of which was the extension for 90 days. We've been building a framework for the IT portion of this, conducting outreach like today's event, developing a lot of guidance that's going to help industry submit their information, and developing the administrative infrastructure that's also behind this rule. All of that is still moving forward towards January 1st, and that continues to be our goal.
And I think it's important to note that the January 1, 2024 date is baked into legislation. So it's not something that can be changed quickly and easily, right?
Right. And even with the start of the date, I would like to emphasize that this is the start. You still have a grace period of a full calendar year for existing companies to submit their information.
As long as there's no change in information, right?
Correct. If there is change in information once you've submitted your reporting, you do have 30 days to provide those corrections.
Yep. And that 30 days, that's what you've asked to have extended to 90 days. Is that right?
The 90 days is actually for new companies.
Just for new?
Okay.
Okay.
Correct.
All right. This is why we ask questions, right? All right. So you mentioned that you've been releasing a lot of guidance to try to help small businesses get ready. Can you tell us a little bit about some of the new resources that you've made available?
Absolutely. As I mentioned, we are undergoing an extensive outreach campaign to educate small business owners as well as business service providers on this new requirement. Again, I'd like to emphasize that a lot of folks are not familiar with our organization or with the CTA. So we know that there's a lot of work to do in this space. And we also know that not all companies are the same. There are an infinite number of iterations of corporate structure to go through. So what we've worked on is developing a series of guidance that ranges from helping small business owners submit their own information through a series of walkthroughs to more sophisticated guidance that might speak to multiple companies, multiple owners, intermediary owners, and various iterations thereof. So most recently, we've published a small entity compliance guide, and we see this as sort of the comprehensive overview of CTA's reporting requirements. And that's where you have walkthroughs for businesses and their owners to determine if and what they need to report to FinCEN. But additionally, because if you've looked at the guide, it's pretty extensive. So we've also worked on creating some brochures, some introductory videos, some slick sheets, and of course, a series of ongoing FAQs that are supposed to speak to what we think are the primary concerns coming out of small businesses.
Yeah,
and we know there's a lot.
Yeah, we agree. So I think you've already answered this question. When will a final version of the BOI form be available? January 1?
So we are working to finalize the BOIR form, as we call it, as quickly as possible. The 30-day comment period on that form just closed as well. So again, that's something that's being finalized through this administrative framework. But we will have it available on our e-filing system starting January 1.
Okay. And you mentioned, working with third parties. Do you anticipate that it'll be something similar to how FBAR filings work? Will there be like that kind of relationship?
Yes, there is going to be an API that's designed to allow third parties to submit these reports in bulk.
Okay.
A number of third-party software developers have already expressed interest in providing that service. So we expect that is something that's going to be popular amongst some of the business service provider community.
Okay, that's really interesting. I appreciate that. And I think it leads perfectly to the next question. What do you see as the role of accountants and CPAs in helping small businesses meet this filing requirement?
So I think the bottom line is that most companies have a relatively simple corporate structure. And we think that at the end of the day, most companies are going to be able to submit their own information based on the guidance that we've put out. We really look towards the business service professionals as educators in this field. So we would look to you as partners in helping educate your customers on this requirement, pointing out where the guidance is. And we do know that some companies are going to need extra help based on the complexity of their structure. And they might turn to their accountants, they might turn to attorneys to look for help and assistance in submitting this information.
Thank you. So one more question, and I thought this was interesting. On your website for BOI, there's an alert at the top about fraudulent attempts to solicit information. Can you give us a little bit of background on that so that we can help respond to our clients as they raise issues?
Yes, a recent fraudulent scheme came to our attention with correspondence that might be titled Important Compliance Notice, and for the recipient to click on a URL or scan a QR code. Once we saw this, we felt it was critical that we share that we've learned about this, that this is something to be on the lookout for. These emails or letters, either way they come to you, they are not from us. FinCEN is not going to send unsolicited requests. And we ask that you practice appropriate cyber hygiene. So don't click on the URL, do not scan the QR code, and always pay attention to the URL where messages come from. If you see something, it's going to come from the FinCEN government website.
That's a great tee up for a segment we're going to have after we wrap up this conversation. Eric, have you been looking at some of the questions from our audience?
Yeah, they're active. It's an active group. So a couple just there's I'll give you some. There's questions on would FinCEN do a mailing or something? Feeling that there's a lot of the clients out there that are not aware of this. So just what type of, is there more outreach beyond what Jonathan has described? But let me just give you some more of the technical questions, Lisa. There's concerns, are CPAs violating the unauthorized practice of law in determining substantial control for BOI? So, when the businesses have these questions, who's the right party to be answering them?
Yeah, so that question has been coming up a lot. FinCEN is not necessarily placed to speak to professional codes of conduct. So we would ask that you look towards your local jurisdiction to determine where that border falls between UPL and providing accounting guidance.
And Lisa, that's when there's questions coming in about this. Maybe we need to have some of the professional liability providers on with a few practitioners kind of working through a few of these use case scenarios. So I just, there's lots of questions. We've got over 100 questions that have come in during the segment. So I think these are things, Lisa, we can unpack and work with FinCEN on, and just continue on this journey of really getting our firms, as aware and as informed as possible. So Jonathan, they're out there, connecting with the 5 million plus businesses. But this is a big lift. This is a heavy lift that's occurring due to the upcoming timeframes.
And as a reminder, on the last town hall, we talked about some of a recent risk alert that the AICPA member insurance program had put out to help give practitioners some guidance on how to engage with their clients around the beneficial ownership reporting and navigating some of the trickier instances. So if you did not catch that one, make sure you go get the replay, and we'll continue to talk about some of the issues as they come up. So we'll provide more information in the follow-up. Jonathan, really quickly, I just want to hit the comment letter that we offered this week. So we've asked for a 1-year extension on the entire BOI reporting, because as you've talked about, it is really complex and we'd like a little more time. But we've also been working with FinCEN very closely, and we appreciate your conversations that you've been having with Melanie Lauritsen, our VP of Tax Advocacy. It's been really good to get to work with FinCEN on this issue. And for our members, we have lots of resources to support you. So as Jonathan was mentioning, raising awareness with your clients is a real issue, and we've given you some client-facing resources that you can use. We've also given you links to podcasts, great Journal of Accountancy articles, information from the AICPA member insurance program that we just mentioned. A lot of good stuff there, and you'll also find a link to FinCEN's site so you can learn more about what they've got in terms of resources as well. So Jonathan, thank you so much for joining. We really appreciate it. And I know this isn't the last conversation.
Right. So, Lisa,
Really
yeah.
quickly for our audience, as we move into cybersecurity, there are just a couple of quick notes on the slide that you can download about some recent news. Thank you to the tax Twitter community for pointing out that the IRS 1040 e-file shutdown happens on November 18th. I know that's always an important date. And then IRS announcing some relief for taxpayers affected by attacks in Israel. So I've given you links to additional information that you can get by downloading the slides and looking at those articles.
Well, thanks, Lisa. We'll have you back in open forum. You can read some of those 100+ questions on BOI. take one or two of them during the open forum session. So now moving into the cybersecurity discussion, October was Cybersecurity Month, so we can bring Randy Johnson and Chris Cromer up. And just let me introduce Randy Johnson. He really doesn't need an introduction. He's very, very well known, really a trusted advisor for all the firms related to technology matters. And we've got Chris Cromer, who's a director at CPA.com, leading a lot of our different technology initiatives. So Randy and Chris, great to have you.
Thank you, Eric. Pleased to be with you and all of the attendees today.
Thanks, Eric. Well, let's get right into it. Cybersecurity Month. I know, Randy, you've been speaking to a lot of firms about this, and you and Chris have got kind of this framework of top issues that the firms and people in business and industry should be thinking about.
Indeed. In fact, we just wanted to identify some top security challenges that are out there. There's many more than this, obviously. Recent reporting from the Identity Theft Resource Center suggests that 73% of U.S. small business owners experienced a cyber attack in the past year. So those statistics are stunning, but not any less so than the phishing statistics. Phishing email statistics suggest that nearly 1% of all emails sent are malicious, which translates to about 3.4 billion phishing emails daily. And extortion of 33 million records is expected to occur this year, with ransomware or phishing attacks occurring every 11 seconds. So this is all over the place. We're concerned because many firms are attacked directly with these phishing attempts. And we think we've got a little bit of a work methodology for you, but unfortunately, I've dealt with CPA firms who have been phished. Even with training, the team members in the firm have fallen prey. Really a terrible thing that's happened here. But additionally, malware as an attack vector. Here in 2023, there's about 300,000 new malware instances generated daily. And about 92% of those are sent through email. It usually takes almost 2 months to be detected. So the problem is the bad actors are getting better faster than the good actors can protect us, regardless of where we have our IT located, whether it's in the cloud, whether it's local or whatever. And, with the new generative AI initiative from the AICPA and CPA.com, we think there's some wonderful things that can happen, but generative AI is also being used as a new attack vector. Fundamentally, the bad actors are using generative AI to create phishing emails, malware, ransomware attacks that are even more able to deceive you and your team members than ever before. And that really leads to the social engineering attacks. So these 5 key things are happening around us at unfortunately high rates of speed. So we've got a few suggestions for you in terms of strategies to mitigate cybersecurity risks along the way. One of those clearly is employee training and awareness. Many of you have a program for that anyway, but products like KnowBe4 and 30 others are in that class. There's a broad variety of email tools that are out there. Many of you are using the Mimecast, the Proofpoints, the Barracudas, those types of products. And we are suggesting that you enable the advanced threat protection that is in your Microsoft 365 instance. If you're complying with IRS 5293 5447 for your written information security plan, which you need for your P10 renewal anyway, we're suggesting that you turn on that ATP, that advanced threat protection, in your Microsoft 365 Business Premium or in your E3, E5 instances. Further, multi-factor authentication has largely been done with products like Duo or now Microsoft Authenticator. And we believe that you have to have multi-factor authentication on at all times. So there are some good best practices out there that we can recommend. And one of those clearly is a restricted top-level domain. So you might have seen that in the spin roll as this session was starting today. But as a CPA firm, you can protect your identity with a .cpa restricted top-level domain. It is harder for bad actors to spoof your online identity. It includes some free threat monitoring, and there are a number of marketing reasons to use these particular domains as well. So, Chris, I know that you have been involved with the top-level domains since inception, as we have been. We recommend them broadly to all CPA firms, that have websites. So, are there other marketing domains and other items that you might suggest to our listeners?
Yeah, well, actually, before we go there, I would say, when it comes to protecting your identity online and using a restricted top-level domain, this is an area, because really what we're talking about here, the threat is domain hijacking, right? An attacker is able to compromise the account that you use to manage your domain, and your domain is this very critical piece of many of your IT services, your website, your email platform. They all rely on that domain. So if that becomes compromised, then you lose access to all of that. So your website is under the control of the attacker, your email. And so just want to point out that this is often, not given the attention it needs, or maybe overlooked a little bit as an area that you need to secure. And as you say, one very easy way to secure that is by using a restricted top-level domain like .cpa. By having eligibility criteria, makes it much harder to spoof, as you said. There's also extra other benefits like free threat monitoring and others as well. We have more information about that on our website, domains.cpa.
Mm-hmm. So I think with that in mind, friends, the top-level domains actually give you branding capabilities as well. And there are a number of firms that have adopted these strategies. And you can see here some examples with agriculture.cpa or woman-owned CPA or bmf.cpa. I have even associates, Brian Tankersley, who has tankersley.cpa. And we recommend that this should be a key part of your branding strategies. And the key thing to note is that .cpa domains are available exclusively for the CPA profession. So, Chris, can you identify what it takes to qualify?
Sure. It's a licensed individual CPA, licensed CPA firm, or an approved organization. On our website, we have the eligibility policy. You can review it there if you like. Mm-hmm. And I'd like to add a little extra color to this slide as well. Starting from the left, we have this great growing community of .cpa websites out there. We see new ones coming up all the time, and they're used in a variety of different ways. Bober, Marky Fedorovich, used it to shorten theirs all the way down to bmf.cpa, which is a great use case. Adams Brown using agriculture.cpa to market their AgriBuilder suite of services. And then Belita Blazingame using women-owned.cpa as she's targeting women entrepreneurs. So there's more than just using it as your primary identity website. There's lots of other use cases as well.
And just there's questions coming in here. I know we've got one last slide here, but Chris, two things. Process for migrating from .com, and just how is this more secure than something like a .com URL?
Certainly, I'll take that second question first. How is it more secure? And there's a number of different ways. First and foremost, it's more secure because we do have that eligibility criteria that you have to meet before you can register a domain in .cpa. So that means attackers cannot go in and register a .cpa that looks like your .cpa domain and use that to attack your clients or do an imitator attack. So there's that. The registrars, this is where you go to actually buy and register the domain, have extra security requirements that we are able to enforce on them. So you know that the portal that you're using is secure. And so that's two benefits right there. And what was the other question, Eric?
Just conversion.
Yes. Actually, that's a great segue for this slide here. Converting is actually pretty. It can be very simple. We provide this free .cpa starter site as a way to help you with that conversion. For firms just starting out, this is a great resource. It's a already professionally designed website, preloaded with content. There's zero technical setup. You don't have to create DNS records or think about design. A couple minutes and you got a professional website up and running. You can use this as your primary identity site, or you can use it as a temporary while you're working out how you want to do that conversion from your .com to your .cpa domain. So conversion, we have resources on our website that really talk about that, and it's a very kind of in-depth question. Our support team can handle that, or please refer to our website. We have lots of videos. Actually, Brian Tankersley has done some of those.
Well, that's great. I mean, Randy, it's just fantastic, Randy, having you here on the town hall talking, technology, cyber issues, and kind of covering, some of the value of a domain that actually the AICPA, worked really top level domain that we worked really hard to get for the profession. So thanks for those insights, and Chris, thanks for your leadership here as well. So Lisa, you had a little bit of time to look at some of the questions. It's been an active town hall community with a lot of feedback across all of these topics, even the cybersecurity topics. So thank you on that. Lisa, is there a couple of things that you just maybe want to summarize? We only have a couple minutes here as we close out.
Yeah, I'll hit one of the questions really quickly, and then we'll follow up in newsletter and then more segments. But one of the questions was, aren't accounting firms exempt from filing under beneficial ownership? And the answer is no, not necessarily. So basically, if the organization has filed like articles of incorporation or registered with the Secretary of State, then you should assume that they will be required to file unless they meet one of those 23 exemptions that are listed in the FinCEN FAQs. So you have to look at the size of the entity, and there are some large CPA firms that maybe are doing PCAOB inspected work that might be exempt, but no, CPA firms are not necessarily exempt. It depends on whether or not they've filed with a Secretary of State or something like that.
Well, Lisa, what we'll do here is we always do with the newsletter. We're going to, follow up, identify the top questions, get you more information on BOI. It's a journey related to that. Great discussion related to the economy in DC with Barry and Steve Leisman. And Randy and Chris, thank you for your time. Lisa and I now are just going to kind of close things out here on the town hall. Thank you. So in summary here, we just covered it, a very, very active town hall. Here's some additional .cpa resources which you can leverage. And here's an upcoming town hall. I know, Lisa, there was some other kind of closing remarks that you wanted to make today, so I'll hand it off to you.
Thank you, Eric. I just wanted to take a moment to acknowledge a loss that we suffered in the accounting profession with the passing of Josh Lance. Many of you may know Josh. He was very active in the community. He created a virtual firm years ago before I even knew they existed. Six-time honoree in our 40 under 40 CPA practice advisor class, Leadership Academy alumni, and unfortunately he passed at the age of 40. If you want to find out more about Josh and how you can honor his legacy, there's a Journal of Accountancy article that you can find by just searching on the site.
Well, Lisa, thanks for sharing that. Busy times, but it's good to reflect and appreciate people like that who've made such an impact. So thank you very much. We look forward to seeing you all again in a couple of weeks on Thursday, November 16th. Thanks for your time today. Thanks for your engagement. Look forward to seeing you shortly.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.